If you're a Canadian homeowner, you're probably struggling to save enough for retirement, and that's because the landscape of Canadian homeownership is different than when your parents did it. Now, Canadian homes are so expensive, we need to make sure that we're using our money more effectively. And most Canadians, 99% of Canadians, aren't doing it. In this video, I'm going to show you a strategy called the Smith Maneuver, and I'm going to walk you through why it's important, how it works, and why you should be considering doing it. My name is Jeff Hamilton. I am a certified Smith Maneuver professional and a mortgage broker by trade. I made it my mission when I retired from my director of marketing gig a few years ago, to educate Canadians on this because I think it's such an important strategy that I do on my own home as well. And so let's dive into why we need a strategy here in Canada. So the problem with the Canadian way. A lot of people don't realize that Canadians and Americans are taxed differently when it comes to their homes. In Canada, we have a massive benefit that we have zero capital gains on any value appreciation that our homes have. And considering the price and appreciation of our homes historically, that's a huge advantage. Americans have a different advantage. They recognize that their homes are actually an investment, and because of that, they consider a mortgage to be an investment loan and the interest on your mortgage to be a tax deduction. So at the end of the year, Americans can write off the interest on their mortgage against their income and reduce their taxes and get a refund. And we don't have that advantage in Canada natively. However, there's a strategy that can help you with that. In Canada, we assume that owning our house outright is the absolute best possible outcome. In fact, there was a bank commercial a long time ago celebrating when you finally paid off your mortgage, and that's great, except for you can't do anything with equity or money that's trapped in your house. And that's basically what equity is. If you own $1 million house outright, that's fantastic. Your net worth says $1 million. But if you need money, you have zero access to it. And so especially in retirement, people are finding, great, I own my house and I can't live off anything. So I can't retire. I have to save. I have to invest. But how do you do that when house prices are so high and your mortgage payments are so high? That's where the Smith Maneuver comes in. So what is the Smith Maneuver? It is not a mortgage. The Smith Maneuver itself is a strategy only. It works in conjunction with other mortgage products. So you can get a mortgage from, say, for example, Scotia or TD or Manulife for your home, and then apply the Smith Maneuver on it. There are a few requirements that you need to look into, and I'm going to go over those now. Oh, actually, I'll go over those in a bit. So I'll go over actually how the Smith Maneuver works first. First off, it has 3 basic steps. This is the Smith Maneuver at the absolute highest level possible. Step 1, pay down the principal portion of your mortgage. And so as your mortgage goes down, even through your regular mortgage payment, you get a HELOC, which is a home equity line of credit attached to your mortgage that will then increase in room. I'll explain how that works in a little bit. You're going to borrow the money from that HELOC room that has just become available to invest. At the end of the year, any interest that was accrued on your HELOC is considered an investment loan and is tax deductible. So you're going to write off that interest against your income. You're going to apply that tax refund that you get to your principal and repeat the cycle over and over again, month after month, year after year, and compound your growth on your investments down the line. So here's how the HELOC plays into the strategy. The regular mortgage in Canada, you pay it down and you lose access to that borrowing ability. So you have $500,000 mortgage. After a few years or several years, you pay it down to $400,000. After many years, you pay it down to $100,000, and then finally you end up with zero. And when you get to all these different levels, the space that you've paid off disappears. It's no longer accessible. With a home equity line of credit, readvanceable home equity line of credit, you start with the same $500,000 mortgage. A few years down the line, you pay down to $400,000. And that for $100,000 is now available as HELOC room. It doesn't mean it's used, it's just sitting there available to be used. So you still have access to that borrowing amount. You don't have to ask permission for it, it's just there for you. And then years down the line, you do pay down to 100, and you've accrued 400,000. And then at the very end, you have no mortgage whatsoever, and you have $500,000 worth of HELOC room. Now, if you've never used it, it costs you nothing, everybody's happy. In this strategy, we're going to show you how to use it effectively so that you can build a large portfolio. The first requirement is the home equity requirement, or I guess the second requirement. So I said, you must be this tall to ride this ride. If you are a new home buyer and you only put 5% down on your home, you will not be able to qualify for a home equity line of credit. That's a Canadian regulation. You have to have minimum 80% loan to value. So a minimum of 80% of your home's value can be in a mortgage. So if you have a $1 million home and an $800,000 mortgage, you qualify. If you have an $801,000 mortgage, you do not until you get down to $800,000. Now at the $800,000 mark, your mortgage isn't going to transfer one for one. With when you reduce your principal, your HELOC is not going to go up one for one. It's going to go up $1 down, maybe 75 cents up until we get to that 65% mark. At 65% loan to value, and you may already have that, it's going to be one for one. If you pay $1 down on your mortgage principal, you get $1 of borrowing room in your HELOC. And that's the ideal scenario, but even at 80%, the strategy still works very effectively. Here's how your monthly transactions work and how this strategy is actually cash flow neutral. It won't cost you a single dollar out of your pocket. So over here, we have our mortgage payment. We're going to assume that it's a $2,000 mortgage payment and that $1,000 of that $2,000 is going to go towards the bank in interest. Interest payments to the bank are unrecoverable. They're gone forever. So be it. The $1,000 that goes towards your principal, you can see right here, is going to reduce your mortgage amount. Now we're assuming we've already done this strategy for a little bit. So we already have $3,100 of our mortgage paid down. Now, when you pay down that $1,000, it immediately becomes available in your HELOC down here. And you can see the previous $3,100 is also available there. Now, we're going to take that $1,000, we're going to put it into a clearing account. Now, a clearing account sounds technical, but it's just a checking account, like any other checking account that's dedicated to be used for this strategy only. Now, because we've been using our HELOC for investments already with that $3,100, we've accrued a little bit of interest on that HELOC. So we're going to use that $1,000 that we just put into our clearing account, take the interest portion, which in this case is going to be $10, and make a payment to our HELOC. That's how the money from the HELOC self-satisfies the HELOC, and that's what makes it not cost you a single dollar. With all the remaining money is $990, we're going to transfer that to our investing platform into a non-registered account and invest in what's called an income-producing asset. And so that can be any stock or ETF that produces a dividend. That's usually the simplest way to know if it's income-producing. And that's a requirement for an investment loan. It has to have a reasonable expectation of earning an income. And so a dividend satisfies that. Now I put it as Wealthsimple here. That's just because it's my favorite. It's really easy to use and simple. And in fact, if you want to try Wealthsimple, I'm going to put a link in the description where you can try it and get a free $25 when you do it. So feel free to use that. Now, is the strategy legal? Let me tell you all what the law is. Yes, the tax deductibility of an investment loan is written into the Canadian tax code. It's specifically Income Tax Folio S3, F6, C1, interest deductibility. Now I'm going to put a link to that as well below so you can read it yourself and don't have to just take my word for it. You can read the whole tax code yourself there. The Smith Manoeuvre has actually been around since the 1980s and has been audited and vetted by the CRA. So this is not a new strategy. This is not a mortgage hack. This is not something sketchy. It is verified and legal and has been used by thousands of Canadians over decades, and it's been really effective. Now, within the Smith Manoeuvre, there is obviously the plain Jane where you can use your mortgage payment and borrow that to invest. That's called the plain Jane portion. But there are other accelerators within the Smith Manoeuvre that can actually speed up the conversion process of your mortgage into a tax-deductible loan and can help you build a greater portfolio by the time your amortization period is up. And I'm going to go over those here. Now, it's important to remember that all of these strategies, all these accelerators are modular and flexible. I don't know anyone that's taking advantage of all of them, but you may take advantage of one or two or three. You may do it 100% effectively. You may try to tone it down. You can kind of manipulate it to be more in line with your goals and your risk tolerances. So here we'll go over all of them individually. The plain Jane's what we were talking about. That's what the example was about, where you take your mortgage payment and invest the principal pay down from there. Cash flow diversion is for people that are already investing or want to start investing regularly. So say, for example, you have an extra $100 that you want to invest every month. Normally, without the strategy, you would just invest it. In Smith Manoeuvre, there's a more effective way to do it. And you're going to take that same $100, you're going to make a prepayment onto your mortgage, you're going to borrow it from your HELOC, and then you're going to invest it. That way, you're reducing the non-tax deductible debt and you're gaining the tax deductions of your investment loan while getting the same investment benefit of your portfolio in your platform. Cash flow dam. Now this can take a few different names and can take a few different forms. The most common that you may have heard online is rental cash damming. This is what this is, but it can be applied to different scenarios like sole proprietorship as well. I'll use the example of rental cash damming just to make it a bit simpler. So say you own a rental property and you get $2,000 worth of rent and you have about $1,500 worth of expenses. You, instead of just taking that $2,000 and paying the $1,500 worth of expenses, you're going to take the $2,000 rent you collect from your tenants, you're going to apply it as a prepayment to your mortgage, you're going to borrow that $1,500 that you need for your expenses and pay your expenses. Any expenses related to a rental property is considered an investment loan, or considered an investment and can be used for an investment loan. So there you have it. Now in that scenario, you have $500 left over. So what can you do with that? You can either leave that $500 just so you're borrowing less to reduce your overall risk, or you can take that extra $500 that you've generated that you haven't used yet and put it in your investment platform as an investment loan for investment purposes in your portfolio. And so you can use it that way. This even works if your expenses exceed your rental income. So it can be applied different ways, but there are ways to make it work even if you're unprofitable with your rental property. Now there's debt swap. If you already have a portfolio in a non-registered account, debt swap says you can sell that entire portfolio, apply the entire amount to your mortgage to reduce your non-tax deductible debt, borrow it from the HELOC, and invest in either the same or different applicable assets with an investment loan. So you've reduced your non-deductible debt, you've increased your future tax deductions and your returns every year that will further accelerate the process. The dividend reinvestment plan. If you're a heavy dividend investor and you're receiving regular contributions from your dividends, either monthly or quarterly or yearly or whatever it happens to be, most people just say, okay, reinvest it in the same assets, I don't need the dividends. But in the dividend reinvestment plan accelerator, you're going to take those dividends in cash, run it through this mortgage as a prepayment, borrow it from the HELOC, and then invest in either the same or different assets that are applicable for the strategy. And finally, prime the pump. You're probably wondering why this one's in yellow. This one is the only one of these accelerators that will increase your risk and that requires an additional payment out of pocket. So this one's treated differently. In prime the pump, say you had a loan to value of 50%. So $1 million property, you had a $500,000 loan. When you qualify for a HELOC, you can qualify all the way up to 65%, no holds barred. And so you're going to have $150,000 of HELOC room right off the bat that's unused. In traditional prime the pump, you would take that entire $150,000 and invest it right away as an investment loan. Then you would be responsible for paying the interest payments on that portion of that loan. However, it doesn't have to be that strict. You can, as I said, it's flexible. You could take an extra $500 a month or $1,000 a month every month from your prime the pump, satisfy that interest with your own money and invest that. Or you can time the market if that's where your skill level's at, or any kind of investment loan you want to do. It's there for you to use, and it's called prime the pump when you do. All right, so why should you do it? If you're not already convinced, I'm going to give you a few reasons. Number one is diversification. Most Canadian homeowners are incredibly concentrated with their investments. They've put probably $1 million into their house, and that's their biggest asset, and they're relying on that appreciating over time and hopefully being able to get some sort of investment so you can live off it in retirement. With this strategy, we're purposely diversifying either into a rental property or investments or business or something else, and it allows you to not rely on one single asset as your only wealth generator or net worth generator. If something happens to your house, either damage that can't be fixed by insurance or the neighborhood that you're in devalues over time and you don't have the asset that you think you did, you're hooped if you only have the one asset. If you have multiple assets and diversification, you can overcome those kind of struggles because you've safeguarded yourself against that kind of crisis, I guess. Dual purpose dollars. Most people are only using the dollars once. In this strategy, we're going to use them twice because every dollar that we're using in the strategy, we're using to pay down our mortgage and convert it into a tax deductible loan and build an investment portfolio either from our rental properties or for our investment portfolio. And so we're making our money work much harder for us than the average person is currently. And three, inflation hedge. This is something that most people never consider. Right now, you have a mortgage and it's a portion of your home value. So let's say this is 65% of the home value. Over time, you're going to pay that down and then you're going to have the home value. Now that's going to go up, your home value. In 25 years, we can expect home values in Canada to increase by anywhere between 2 and 4 times their value. So it's an incredibly good investment that's not considered an investment. But if you use that same mortgage for investing the entire time, in 25 years, you're going to have an investment loan that's the same exact amount. You're going to have a portfolio that's grown and compounded for 25 straight years, and you're going to have that massive growth in your home value that you would have had anyways. Because your home value does not care if there's a loan on it. It's going to increase or decrease the same, regardless of whether you owe money on it. And it always reminds me of that meme where we say, old people, when they realize they bought their house for the equivalent of 5 raspberries. It's because a mortgage that was significant way back when, because of inflation, is no longer significant. And people always think, oh, I wish I bought a house 25 years ago. But they don't think about the fact that if they buy a house now, that same effect is going to apply to them in 25 years. So this loan amount here is tiny when you consider the loan amounts that other people are having to take out to get homes at that time. And this strategy is really going to make you maximize your ability to take advantage of the decreasing value of your loan. So how to start? There's 2 fantastic ways to start. First, we have the do-it-yourself crowd. If you want to figure this out yourself, you want to do your own research, I absolutely encourage you to do that. In fact, I encourage you to do that so much that I made a free course. The free course is going to teach you start to finish why you need the plain Jane, how to do it, all the steps you need to take, etc. So you can implement the plain Jane version of the strategy entirely on your own. I encourage you to join that. There's always risk when you do it yourself, but if you take your time, you can learn a lot in that course. Then there's launch support. This is my done for you service, and in it I include a full strategy plan. So it's not just the plain Jane. We're going to take a look at every accelerator within the strategy for you. We're going to look at your goals, your expectations, and we're going to craft something that's specific just to your needs and your situation. I'm also going to create a monthly actions checklist. This can be a complicated strategy to implement, and I'm going to simplify that down to the easiest possible steps that you can take to make sure you're getting the maximum benefit each month. There's going to be a custom tracking sheet that I provide that will be specific to your situation again. It's going to help you keep everything sorted and organized and give you the actual dollar amount that you need to do and move around, so that if the CRA ever asks to see what that investment loan has actually gone towards, you're going to be able to have a tracking sheet that you can provide them that's going to clear everything up and make the whole process very simple. I provide 3 months of transaction support because when you're doing this, it is very different from what you're used to. You're going to feel like you're making mistakes, and I'm going to be there to ensure that you're doing everything correctly and give you that reassurance that it's all done correctly. And then 1 full year of support. Some people go into the strategy thinking they want to be really conservative, and 5-6 months later they realize I have way more potential to contribute to the strategy. We can readjust and reconfigure your strategy to do that, or the opposite. They start aggressive, they want to tone back, or a life situation changes and when they need to adjust. I'm here for a full year to make any adjustments you need to make sure the strategy is working for you. So if you want to join the free course, there's a link in the description for my free course. If you want to book a free call, there's going to be another link in the description. So feel free to do either or both. I just want to make sure that more Canadians are getting the benefits that they should be getting out of their home. So please take advantage of either option that works for you. Thank you for watching my video. I hope it's been helpful, and I hope to see you interacting with my content and getting more out of your home.